The ongoing global trade conflict triggered by America's recent tariff policies has become increasingly worrisome for the United States. Initially intended as protective economic measures, the tariffs have instead led to swift and severe retaliatory responses from key trading partners, including Canada, the European Union, Mexico, and Brazil. The scale and intensity of these responses signal troubling times ahead for the U.S. economy, potentially undermining its economic stability and global standing. A troubling start. President Donald Trump's administration introduced hefty tariffs, 25% on steel and aluminum imports, targeting strategic trade partners such as Canada, Mexico, the EU, and Brazil. This drastic step, intended to shield domestic industries, quickly triggered retaliation, signaling an escalation that threatens not only trade but overall economic health. Canada, one of America's closest allies and trade partners, responded immediately and decisively, announcing retaliatory tariffs amounting to a staggering $760 billion USD. This aggressive response targets crucial U.S. exports, including agricultural products, consumer goods, and industrial equipment, presenting an immediate risk to American businesses reliant on Canadian markets. The European Union also quickly retaliated with tariffs totaling approximately $40 billion USD, affecting more than 2,800 American products, notably Levi's jeans, whiskey, motorcycles, and aerospace components from Boeing. Such targeted measures could severely impact key American sectors, leading to significant financial strain and potential job losses in affected industries. Mexico and Brazil, strategic threats. Mexico's measured yet firm response highlights another significant area of concern. Though Mexican President Claudia Sheinbaum Pardo initially prioritized diplomatic negotiation, Mexico's capacity to disrupt vital American supply chains, particularly in agriculture and automotive manufacturing, poses a severe risk. The potential imposition of tariffs by Mexico on U.S. products like tomatoes, avocados, beef, and corn could drastically reduce American agricultural exports, devastating farmers and leading to higher consumer prices domestically. Brazil, similarly, has shown reluctance to escalate quickly, but has openly criticized U.S. tariff actions, threatening legal responses via the World Trade Organization, WTO. If Brazil eventually imposes retaliatory tariffs, it could significantly affect U.S. exports, especially in sectors already strained by current trade tensions. Provincial backlash. From Canada. Beyond the national response, Canadian provinces have launched their own targeted economic measures. Ontario, a key economic partner for several U.S. states, imposed a 25% tariff on electricity exports. This action directly affects about 1.5 million households across Michigan, New York, and Minnesota, threatening increased electricity costs and potential supply disruptions. Ontario Premier Doug Ford has warned that these tariffs might escalate further, including the potential suspension of electricity exports entirely. British Columbia has also enacted aggressive measures, placing new tolls and restrictions on U.S. trucks passing through to Alaska and tightening import regulations. Additional provincial responses include Nova Scotia's exclusion of U.S. companies from government contracts and Alberta's warnings of further punitive actions. Such actions at the provincial level underscore the severity of the issue, threatening to disrupt critical supply routes and significantly impact American businesses operating in or through Canada. Economic fallout, a growing concern. The immediate economic repercussions within the U.S. have already become evident. Following these retaliatory measures, stock markets in America saw significant downturns, particularly affecting key industries such as steel, aluminum, and automotive manufacturing. Major corporations like Ford, General Motors, and Tesla faced disrupted supply chains and rapidly escalating production costs. If the situation persists, this could translate into higher consumer prices, reduced competitiveness, and potential job losses. The longer-term implications could be even more troubling. As Canada, the EU, Mexico, and other nations swiftly pivot away from dependence on American trade, the U.S. risks significant economic isolation. Canada's deepening trade ties with Europe and Asia, bolstered by agreements like CETA, signify a strategic shift away from reliance on U.S. markets. These changes, if permanent, will likely reduce America's leverage in future trade negotiations, further endangering its economic interests. Energy and economic security risks. One of the gravest threats posed by Canada's response lies in energy exports. The U.S. heavily relies on Canadian oil and electricity imports. Canada's decision to leverage this dependency by imposing electricity tariffs threatens increased energy costs and potential shortages. Additionally, Canada's strategic pivot toward Asian energy markets reduces America's future bargaining power, creating potential vulnerabilities in the U.S. energy sector. Similarly, Mexico's pivotal role as a significant supplier of oil and automotive components to the U.S. represents a critical point of vulnerability. Any serious disruption in these sectors could lead to rapidly rising fuel prices and severe supply chain disruptions, deeply impacting American manufacturing and consumer markets. Political ramifications. These tariff escalations have also led to significant political shifts. Within Canadian government has seen a surge of nationalist support in response to American trade actions. Canadians, traditionally close allies to the U.S., have rallied around Trudeau's assertive stance against what they perceive as unjustified economic aggression. This shift could have lasting diplomatic implications, reducing America's political capital and complicating future international cooperation. Mexico's political landscape is also becoming more challenging for the U.S. Mexican President Claudia Sheinbaum has made it clear that while Mexico desires peaceful resolution, it is fully prepared to escalate trade measures if necessary. The firm stance adopted by Mexican leadership signals diminishing patience and could severely disrupt bilateral relations, further complicating America's economic position. A looming economic crisis. The persistent escalation of these trade conflicts raises serious fears of an impending economic downturn. Economists warn that continued tariffs and retaliatory measures could trigger inflationary pressures, decrease consumer spending, and ultimately push the U.S. economy closer to recession. The disruption of supply chains and international trade flows further intensifies these risks, potentially eroding the economic growth achieved over recent years. Can the U.S. withstand this trade war? As global partners actively diversify away from the U.S. market, the urgency for America to reconsider its tariff strategy becomes apparent. Failure to resolve this rapidly escalating trade war could lead to long-term economic damage, weakening America's global standing and economic security. The combination of immediate business losses, strategic economic isolation, and disrupted supply chains paints a worrisome picture of America's economic future. In conclusion, the tariff wars initiated by the U.S. have evolved into a dangerous gamble with potentially devastating outcomes. America stands at a critical juncture where continued escalation might not only undermine its economic stability but also diminish its global economic influence significantly. Resolving these tensions swiftly and strategically is crucial to safeguarding the nation's economic prosperity and international relationships.